Welcome and good morning. We've got just under about 100 people on. I'm sure more will hop on. This is a real exciting class. We're going to be talking about 1031 exchanges, tax deferral for your clients, how you can put more deals together. We call this the power of exchange. I'm going to be your presenter. My name's Scott Saunders. I've been doing this for about 34 years, started doing it in 88, the former president of the Trade Association. So I have a lot of knowledge on 1031 exchanges. But before we kick off the class, this is hosted on and put on by our parent company. So asset preservation is part of Stewart Title. We're their exchange arm. We do all of their 1031 exchanges. We support them. We work very closely with all of the Stewart closers. They've all been trained on 1031 exchanges. They understand the process, the mechanics. And so we work seamlessly with Stewart Title to help you and your customers put together exchange transactions. So what I like to do just here at the very beginning is, turn it over to kind of the person that pulled this all together, which is Stewart Title, and bring on Rhonda Owen, who's the sales manager. Rhonda, why don't you share a little bit?
Absolutely. So for those of you, I do see, I was scrolling through the participant list, which is up to 111 right now, and I see lots of familiar names. So thank you for joining us. And those who haven't, don't know anything about Stewart Title, we've been around since 1893, which is just 17 years after title insurance was invented. And asset preservation, like Scott said, is one of our companies under the Stewart umbrella, and we are growing by leaps and bounds every day. And I'm really proud to work for Stewart. I've been with them for 13 years. We have a great sales team, which will show you guys some of their information later so that you can find the sales person that is able to accommodate you and connect you with asset preservation. And along with all of our other tools that we have some great farming tools to help you. We have a great expired listings class to teach you some of the psychology about what a homeowner is going through when their listing has expired, and it will help you get that listing back on the market. We have lots of other classes too. We can do them via Zoom. We can do them in your office, in person. We can do them just a one-on-one with you alone. So please reach out to one of our salespeople. And thank you so much, Scott, for joining us and doing this much needed, apparently, since we had almost 500 people registered, much needed class on 1031 exchange. So I'm going to turn it back to you. And if we're excited, give us the info.
All right, let's dig into it, everybody. I am excited to do this. Now, ask questions in the chat. I may or may not be able to get to them all, but I will try. At the end, I'll have my contact information, Rhonda's as well. Shoot an email or call. And I want to, Stewart is putting this on because they want to help you put deals together. And they obviously want you to come to the great people at Stewart Title to close the transactions. So that's why we're doing this. We're showing you what's available in the marketplace. Let me just show you a quick disclaimer right here at the beginning, just as we get going. There we go. We're not providing tax or legal advice. Everybody should talk to their own tax or legal advisor about their own situation. Now, 1031 exchanges sound complicated, but I just want to break it down at the most basic level. Here's what a 1031 exchange is. Somebody in a taxable sale sells a property and they receive back cash. That's a taxable sale. In a 1031 exchange, they transfer a property held for investment and they receive back another what we call like-kind property, also held for investment. So sale, property for cash. 1031 exchange is going to be property held for investment for other investment property. So that's kind of the difference. Now, why we do this, you'll see, and this is a common misconception. People typically ask, well, what is the capital gain tax? Here's the reality. There are 4 potential taxes you pay on a sale. First, all of that depreciation that you've taken is recaptured at a rate of 25%. So it's even higher than the federal capital gains. So if you've owned a property for 20, 25 years, you could have a huge amount of depreciation recapture taxed at 25%. The remaining federal gain is going to be taxed at either 15 or 20%, depending upon your taxable income. Now, there's another thing called the net investment income tax, and we'll look at that in just a few slides. But any what we call net investment income, unearned income, over a threshold of 200,000 for single filers or 250,000 married finally jointly faces an additional 3.8% surtax. This is nationally. And then finally, state taxes. Now, I know your first thought is, well, I'm in Florida, so state taxes aren't an issue for us. And that's true. However, a lot of your clients are coming out of states like New York or New Jersey or Minnesota or other states with high state taxes. So you've got to consider that because they might be facing that state tax if they sell and don't do an exchange. And by the way, that's why we've really seen a surge in 1031 exchange activity these last few years. All across the country, properties have appreciated. So even if the market right now is a little flat or maybe down a tad or up a tad, the fact is anybody that's owned any investment property for more than 2 or 3 years is going to have significant capital gains. So when we look at the taxes, federal taxes, you'll see there's the threshold for the 20% rate, and then everybody below that pays 15%. The net investment income tax applies to capital gains. So this was put in tax law back in 2010 to pay for healthcare reform, for Obamacare. So it's an additional tax that real estate investors face. Fortunately, we have something that's been in the code now for 102 years. So 1031 became a part of the tax code back in 1921. And it essentially says any property held for investment or used in a business can be exchanged for any other property held for investment or used in a business, and all capital gain taxes are deferred and kicked into the future. The reality is people that own investment properties, and when we think investment, we're going to look at that a little bit later in the presentation, but things like second homes and vacation homes may fit into that category if it's done properly. So investment's very, very broad. This is a powerful tool to build wealth. In fact, a lot of people that move into commercial property maybe started with one single family, and then they went into two, and then a fourplex and an eightplex, and then into commercials. So 1031 exchanges allow the average everyday investor to increase their return on investment and acquire more property. It's a powerful tool to do that. Here's the actual tax code. So I'm just going to read it. It says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. So in the very first line, you see a key word, no gain or loss shall be recognized. This is what we call non-recognition treatment, meaning the tax is deferred. It's not a tax-free exchange, it's a tax-deferred exchange. So the tax liability follows the taxpayer from one property to the next. Now, the reality is a lot of investors exchange over and over and over. And then when they pass away, they pass on the property to their heirs with what is called a full step up in basis. So the fair market value of that property at the time it's acquired by an heir, they don't pay capital gain taxes, the investor, throughout their lifetime, and neither do their heirs pay capital gain taxes. So it's a very, very powerful tool. We'll look in a moment as to what like-kind property is, but you're going to see it's really, really broad. By the way, I do see questions in the chat bar. I'm going to kind of not pay attention until we get a little further in, just because I want to keep on track through the material, but I have allowed some time at the end to address questions. Now,
I think we're good, Scott. The question I see was, is the slide deck going out? And I said yes, along with the recording. So just wanted everybody to know that.
Perfect. So there's some things you cannot exchange, some exceptions. The first one is kind of an interesting one. Stock and trade or other property held primarily for sale. So stock and trade would be development property, dealer property, but the category of other property held for sale is much broader. So somebody that does a fix and flip, if their intent is to hold for sale, not long-term investment, not rental income, that's excluded from 1031 treatment. And then I want to draw your attention to the fourth bullet point. A partnership interest. You can't exchange out of a partnership interest. You can't exchange into a partnership interest. So the partnership can do an exchange into another property. But if you have various partners or LLC members, there's some planning you're going to have to do because you can't exchange the partnership interest. Now, we have some ways to work around that. Some things called a drop and swap or a swap and drop approach. So you can reach out to us and we can discuss your situation. It's a little more detailed than I can get into in kind of an introductory presentation. But on the next slide here, the IRS doesn't have a bright line test to determine if property is being held for sale or long-term investment. They're going to look at a whole bunch of factors. So they'll look at things like this: purpose for which a property was acquired, how was it held, how was it being held at the time of sale, were improvements made to the property. If somebody subdivides a piece of dirt and they cut in roads and run utilities, they look a lot more like they're a dealer holding for sale than long-term investment. The frequency, number, and continuity of sales, the extent and nature, the ordinary course of business of the taxpayer. So you might have a client that's a dentist that they turn over 2 properties in 1 year, but they get most of their income out of the dental practice. Well, that might be something that's to their benefit. And the last 2 are where people can get in trouble. Any active efforts used to obtain a buyer to purchase the property. Think of a for sale by owner, a FSBO, or I'm assuming most of you on this call are real estate agents and professionals listing the property with a real estate agent or broker. That makes it look like it's being held for sale, not long-term investment. So this is kind of a flavor of it. Your general rule of thumb: if it's held for sale or development, it's excluded. If it's rented and been held for investment, it can qualify for a 1031 exchange. Now, an important concept in any exchange is to just keep in mind the tax owner that gives up a property should be the same tax owner that purchases the replacement property. So you want to look at who is that tax owner. For example, wife relinquishes, the wife acquires. This could come into play when you've got husbands and wives that maybe have remarried and combined assets. So it can be a little tricky. If an LLC or corporation relinquishes, the same entity has to buy. And I say it this way because I can sell a property as Scott Saunders, and yet I can buy in Scott Saunders' single member disregarded LLC, and it's the same tax owner. So sometimes you need a little bit of help. And just to let you know, at Asset Preservation, we've done hundreds of thousands of exchanges. We have a lot of experience in identifying these issues up front, making sure that when you go into it, things are structured properly. So a good qualified intermediary is really a critical partner on your deal, just like having a really good closer and title company working with you in a partner is really critical. And that's why, we work so closely with all of the Stewart closers all around Florida to do that. Now, I want to switch gears a little bit, and I want to bring up a picture here. Like-kind property, there's that myth that like might be, can I go dirt for dirt or can I go single family for single family? Anything that your client holds for investment purposes, anything can be exchanged for any other property held for investment purposes. So I could go out of a piece of bare land into a single family rental, into a vacation home, into a duplex, into an apartment building. So if you look at that screen, those are all examples of like-kind property. Now, what I'm going to do on the next few slides is go through fairly quickly some things you maybe haven't even considered are considered like-kind, just to show you how broad it is. But the easier way to look at this is maybe to look at what you can't exchange. Number one, you can't exchange the home you live in. So if it's your primary residence, that's excluded from Section 1031 tax deferral because you live in it. It's not held for investment. So that's the first type. Section 121 applies to your home. The other type then is property held primarily for sale or dealer property. Other than those 2 exclusions, any property, whether it's improved or unimproved, held for investment or in a business can be exchanged for any other. So I could go out of an investment property into a business. I could go from a business to an investment. I can go business to business. I can go investment to investment. It's real broad. So look at the last bullet point down. It could include bare land, commercial property, single family rental, short-term rental, multifamily, industrial, easements, air rights, water rights. And then we'll discuss this in great detail, the vacation home issue, and even something called fractional ownership. So it's very, very broad. Now, I'm intentionally going to go through the next slides fast because they're a little, they may not apply to everything. Air can literally be exchanged, an air right or a transferable development right. So if I'm in New York City and I got a 20-story building and I have the right to add 10 stories, that's literally air, and I can exchange that for a fee interest. Easements of all sorts can be exchanged. A conservation easement, an agricultural easement, lots of different things. We did an exchange here in Colorado, which is where I'm speaking from. There was a good size exchange where some additional conservation easement was put in place for the city of Boulder. It was about $10 million. The sellers did an exchange into apartment buildings. So all sorts of easements can be exchanged. Now, here's one you probably wouldn't think of. Certain oil, gas, and mineral rights can qualify. If it's a royalty interest, the right to extract and suck out as much as you want, that can qualify. A production payment doesn't. So some people for diversification get into oil and gas. What I want to spend a little time on, and if you have questions, I'll be checking the chat, is this next topic, because I think this is one where Florida really has a lot of potential. A vacation home that has never been rented will not qualify for an exchange. If it's just a second home vacation home sitting there without any rental income, it doesn't qualify. However, there are ways where you could have a vacation property or a second home also held for investment qualify. So a number of years back in 2008, the IRS came out with what's called Revenue Procedure 2008-16. And they said, if you stay within the parameters of this revenue procedure, the property will be considered held for investment. For those of you taking notes, the easy way to remember this is the rule of twos. That's just the way I remember it. It's just three different things to remember. Number one, you have to hold the property for a minimum of 2 years. So there's a 2-year holding period only on a vacation or second home. That doesn't apply to other exchanges, but 2 years. The second requirement is within that 2-year window, in each year, you have to have a minimum of 2 weeks of rental use. And if you look at the bullet point under requirements, look at the third one down. You can actually rent to a family member. So you can rent it to your brother or sister as long as they're paying fair market rent. So there's no prohibition on that. It is the last requirement that trips up a lot of people. Your personal use cannot exceed 2 weeks. So your personal use can't go over 2 weeks in that particular format. So you've got to hold it for 2 years. You've got to go ahead and rent it out for at least 2 weeks in each of those 2 years. And then you've got to go ahead and make sure your personal use does not exceed 2 weeks or 10% of the time it's rented. So I'm going to answer a few questions that are coming in here that I see right now. What defers long-term? So Jennifer, I'm going to get into the time period that you have to hold a property in just a moment. This deals with a vacation home. A property built to fix and flip, you buy in January, rent it in February and March, or put it for sale. Does it qualify? Probably not. It's got to be held for investment. So just a month or two is very, very aggressive. Some CPAs and attorneys like to see a year or more, others 2 years or more. That's not a requirement, but a couple months is not going to be enough. Eric, the 1 for 3 and 3 for 1, I'll get into that issue and address that one later. By the way, for everybody, we're going to have a recording of this and we'll have the PowerPoint available. So thanks for the questions so far on that. When I look at this, I just want to make sure you're clear. This is a lot of potential in Florida. Somebody could exchange into a vacation home and hold it this way for a 2-year period. After 2 years are up, they could do whatever they want with it. They could have it sit there vacant. They could rent it as much as they want. So a vacation home or in a resort area is a really powerful planning opportunity for many, many investors. And we have, by the way, and I'll send this over to Rhonda after the presentation. I have a whole handbook on how to do vacation home exchanges. It goes into all the issues. So Rhonda, I'll ping me and I'll be sure to get that over to you for anybody that wants it. I think this is a great planning opportunity. I see a question here. Can an international owner who is reinvesting in the U.S. use this. When you look at exchange, it's got to be domestic property for domestic, U.S. for U.S. There are a couple little caveats. You can exchange into Guam, Mariana Islands, and the U.S. Virgin Islands if it's income producing. Puerto Rico does not qualify, and bare land does not qualify in the U.S. Virgin Islands. So U.S. for U.S. predominantly. You can also do an international exchange. We could exchange from Mexico into another internet. So domestic for domestic, international for international. You cannot exchange international for domestic. So you can't do that. Hans, I believe we have all the emails and the registration. So what I'll do at the end, see the question, does the maximum of 2 weeks personal use apply? No. So let me answer that question. After 2 years are up, you can do whatever you want with the property. You could not rent it ever again. As long as you do that 2-year window, you're in good shape. So that's what happens there. All right, I'm going to move on. And thanks for the questions, everybody. We're trying to make this relevant. Remember, our goal here is to help you put deals together. There's one last category, which is what I call fractional ownership, where a bunch of co-owners own a slice of a larger building, like an apartment complex or shopping center. So most of these are done today in what's known as a Delaware Statutory Trust, or a DST. So you have a bunch of co-owners. You can have literally hundreds of people co-own a property together. These are very unique. So I don't want to go too far down the road with these. These are treated by the SEC as a security, but they qualify as for exchange property. These are not sold through real estate professionals. They're sold through registered financial advisors that have the appropriate security licenses. So the big benefit of going into a DST or a TIC is you go from active ownership into relatively passive. The sponsor manages the property. The sponsor lines up the financing, et cetera, et cetera. So those are the advantages. The disadvantage, or the thing to look at the end of the day, you're still buying a piece of real estate. So you want to make sure you like the type of real estate you're buying. You like the track record of the sponsor. You like the property you're buying. You like the leases. So these are a little bit more kind of a hybrid on the commercial side, but they are a viable 1031 exchange alternative that you can certainly consider. I'm looking at here. Okay. Comments are all good. All right. Now I'm going to go on to that one question that we got, which was that time period. And this is an area where there's a lot of bad information or misinformation. Here's the straight scoop. And I've been doing this, since 1988. I know the tax laws very well. So take away this concept. There is no mandatory holding period. There's not a year or a year and a day. It is all on the intent of the taxpayer to hold property for investment purposes. It is the intent. Now, the IRS is going to look at objective provable factors that either support the investment intent or contradict it. So, and they're going to look at everything. So is the time period important? Of course it is. But they're going to look at all of the variables. In a perfect situation, your client would have a lot of factors that support their intent to hold property for investment, that support that rather than contradict it. Now, I've got a case there at the bottom, and I won't go down the whole rabbit hole of case law, but in Reesink versus Commissioner, which is about 11 years ago, they held it for 8 months, and yet it was considered held for investment. So those of you that maybe heard you've got to hold it for a year or a year and a day, it's not true. They have to have the intent to hold for investment, and then good facts and circumstances that support that investment intent. That's really kind of the key variable there. So Lisa's got a great question about a delayed exchange. Is there an option to extend the time period over 180 days? And so, Lisa, the answer is this. 99.9% of the time, the answer is no. If you have property or tax records in a county that is in a presidentially declared disaster area, you could be eligible for a 120-day extension. So if I'm in Florida and the hurricane that came through recently, and I have a county that's affected, that county, if it's in a presidentially declared disaster area, property owners there get a 120-day extension. Lisa, for the rest of everybody, it's set in stone, the time period. There's no way to extend beyond 180. Even if there's a construction delay, or when we had COVID with not able to get materials, you're not going to get any break. It's a statutory time period, and you've got to complete the exchange within that statutory time period. Great question, though, Lisa. Appreciate that. So I just wanted to touch upon the investment intent. We get this question quite a bit. It's a common one. Now, in the next slides, I want to walk through what do you need to do for 100% tax deferral. When you do an exchange, you're going to sell a property. So I've got an example here of selling for $900,000. The mortgage payoff's $300,000, and now the cost of sale $60,000. Well, what's that going to be? It's going to be your commission as a real estate agent or broker, right? It's going to be the closing costs that Stewart Title has on their end, leaving net equity of $540,000. So the general principle is this. Number one, you want to reinvest all of the net exchange proceeds, the net equity after closing costs. So that would be on the settlement statement, proceeds due seller. Number two, you want to have the same or a greater amount of debt. So if I have a $300,000 mortgage payoff, I want to have at least $300,000 or more. If I want to go down in debt, then I need to bring in outside cash to offset that. So if you get cash out of the transaction, there's a term for that. It's called cash boot. If you get reduction in mortgage, that's called mortgage boot. So you take the cash boot, you add it to the mortgage boot, and now you have the total taxable boot. So what I wanted to do is walk through this relinquished property, show you an example with full tax deferral. So this investor buys for $1.2 million. They go up in debt and they reinvest everything. This is an example of 100% tax deferral, no boot at all. Now, on the next slide, we're going to look at the same sales price, but they're buying for $700,000. So the debt goes from $300,000 to $260,000. So there's $40,000 of mortgage boot. They put $100,000 cash in their pocket, add the $40,000 mortgage boot plus the $100,000 cash boot. There's $140,000 of boot. Now, keep in mind, boot is not bad. In fact, about 1/3 of all taxpayers and investors receive some boot. So don't think with an exchange, you have to put it all into a bigger property. You always have to get full deferral. Some people can't find the perfect property. Some people want to take a little money out, take a trip to Europe, put in a home theater, buy a motorhome, boat, whatever it might be. So you don't have to have a fully deferred exchange. So this is an example of partially deferred exchange. It's very common. And I think when people realize that, it may open up some potential planning opportunities. So that's what you need to do for full tax deferral. There are a whole bunch of different ways to do an exchange. We're going to focus on the third one, the delayed exchange with a qualified intermediary, oftentimes called a QI. So about 97% of all exchanges are going to be delayed exchanges where you close on a property and then you have a time period to close on the replacement property. And what I want to do here is just walk you through the steps. You might have questions on this. This is what your clients are going to be doing almost all the time. So up top is the real estate investor. I call them a taxpayer. They have a property held for investment. They're going to list it with you. When you get the property under contract, at that point in time, you want to call a qualified intermediary and set up an exchange. So a takeaway, you can't set up an exchange after you've closed on the sale. You have to set it up before closing. When you do that, the qualified intermediary, through an assignment of the contract, is going to step into the shoes of the seller. The qualified intermediary is going to sell the property to the buyer. So we are going to ask Stewart to directly deed it to the buyer. And the buyer is going to give us, the qualified intermediary, the money because we sold it. So we're actually on the settlement statement. It would say Asset Preservation Inc. as qualified intermediary for Mr. and Mrs. Smith. We sell it. Now on the purchase side, it's the same thing, but in reverse. Your client makes an offer on a property. They get it under contract. We are assigned into their purchase contract. So key, you have to have an assignable contract, nothing that prohibits assignability. We take the money we're holding, we purchase the replacement property, and then we instruct the closing officer at Stewart to directly deed it back. So if you look at an exchange up here, It's merely the taxpayer giving up deed and receiving back replacement property. The qualified intermediary sells to the buyer. The qualified intermediary purchases from the seller. Now you'll see the time deadline at the bottom. Day 0 is the closing date. It's not when you're under contracts. Now, when you sign a contract, it's the closing date. So keep that in mind. Day 0 happens when you close it. I'm going to go through the questions here before I move on. Does the property need to have damage in a disaster area? From Lisa. No, great question. You just have to have a property that's in a presidentially declared disaster area. If it doesn't have damage, you still, by default, get the benefit of that extension. So that's a great question there. From Paige, what if there is no debt and no mortgage? It's all cash. You sell for $375. Must you buy for $375 or more? Great question, Paige. In that one, there's no debt, so you don't need to reinvest that. But if I sell for $375, I'm probably going to net out $360,000, right? Because I have closing costs, your commission. So you don't have to buy for the value. You have to buy for the net sales price after closing costs. So if I sell for $375, somewhere like $360 or so, the net amount is what has to be reinvested. So great question there. Maggie, can you buy more than one property in exchange for higher value than the maker's property? Maggie, absolutely. You can buy one, you can buy two, you can buy multiple. I've done several exchanges personally where I sold one property and I bought 5 replacement properties. So absolutely, it doesn't have to be one for one. It could be one for multiple. From Eric, can you identify your acquisitions before the sale date? Excellent. Eric, this is a great question. Smart thinking. I actually recommend that you start looking for the property you want to buy as soon as you're listing the property that you're selling. Start that process. There's no reason to get under the pressure of that 0, 45, and then in 180 days. You can start looking, you can start making offers, you can make contingency offers, you can get it under contract. So that's a great solution. In fact, I'll tell you personally, when the market was crazy, I didn't even list my property being sold until I locked up my purchases. That's what I did. I was selling in Arizona. I knew I could sell it and have it under contract in a day or two. So I focused all my attention on getting the property that I wanted to buy under contract. So a great strategy, really smart. Before the closing date. Yes, no, I got that there. From Claire, does the listing have to disclose the 1031 original contract between the QI and buyer? So, Claire, that's a great question. I'm going to kind of give you a 2-part answer. The short answer is no. You do not have to disclose in the contract you're doing exchange. It's not required. You have to have an assignable contract. So if your contract prohibits assignability, you can't do an exchange. But you don't have to disclose it's a 1031. Now, a lot of people, as a business practice, myself included, will include an addendum. And by the way, Rhonda will have the language. I'll be sure to get this to her as well, of the exact language to put into the contract, both on the sale and purchase. So we call it the 1031 exchange contract language. I'll get that over to Rhonda as I follow up on this. So we can get you that, but you don't have to have that in the contract. Okay, from Elena, can I buy outside the U.S.? You cannot go U.S. to foreign property. It's got to be domestic to domestic or foreign to foreign. From Justin, after 2 years, can the owner file for homestead? Justin, I've got some slides on this, so sit tight. I'm going to go back to this one exactly. I've got some good slides. Let me move on, and hopefully I'm answering your question as we go along. The time requirements in exchange. Day 0 is closing. You have until midnight of the 45th day. So we call this the identification period. You then have another 135 days for a maximum of 180 to close on that property. So 0 is closing, 45 days to identify, and then a maximum of 135 days to day 180, or look at the fine print. The day you must file your tax return, whichever is earlier. So it's a maximum of 180 days. If you file your tax return on April 15th and you closed in December, you need to file an extension, complete your exchange in 180 days, and then file your tax return. So these are the basic time requirements. And I'll tell you, at Asset Preservation, our job is to be in the service business. So as soon as you close, we'll let you know the 45, 180 days. We'll provide a summary of the identification rules. We'll provide a form to identify on. So we try to make this as user-friendly as we possibly can. Now, there are 3 separate identification rules. Under the 3 property rule, you can identify 3 properties of any fair market value. So I sell for 300 grand. I could identify one at $500,000, $1 million, and $5 million. The value doesn't matter under the 3 property rule, but no more than 3. So the first one, you're limited on the number, but you have an unlimited value. The 200% rule is kind of the inverse of that. I can identify as many as I want, but not over twice the value of what I sold. So if I sell for 300,000, I can identify a bunch of small properties, but 600,000 is the max. So first one, 3 properties, unlimited value. Second one, the value is capped at 200%, but you have an unlimited number of properties. Those are the 2 most popular rules. Very rarely do we see anybody use the 95% rule, but that just says you identify more than 3 and more than 200% of what you sold. You now must close on 95% of the value of the properties that you identified. So let me go check out the questions here. Give me just a second. Look at some questions coming in. And all right. What happens if I don't find a home in 180 days? Do I have to pay capital gains? It's actually a little different than that. If you don't identify within 45 days, we return your money to you on day 46. So if you don't identify within the time period, you're going to have to pay taxes, then we return the money and it becomes a taxable sale. So there's no way around the 45 days. You either identify in that 45-day period or you don't. So that's a good one. Do we have to work with a title company, or is it 1031 or another company that does 1031? Great question there. You've got to work with a title company, and I highly recommend Stewart because they do a great job and they're the best. You have to work with a title company anyway to get the title insurance, settlement statement, the deeds, all of the closing procedures. A 1031 company is called a qualified intermediary. So you need closer, title company, and you need a qualified intermediary. The qualified intermediary is going to prepare the paperwork. We are going to physically hold the funds in a separate bank account. So you need both a title company and a qualified intermediary. Sometimes you'll hear us called a QI, an intermediary, an accommodator. They're all synonymous terms. Will the 1031 reimburse the end for the purchase or replacement property? Will that be out of pocket? Let me see if I'm reading that correctly. Margarita, will we replace the end for the purchase? Oh, I think what you're asking about is the earnest money deposit. Your client can advance the earnest money. We can replace it with the exchange funds after we're assigned into the contract. So that's the issue there. Next one. Identify under contract. So this is a great question. And on my next slide covers this. You just have to, in writing, identify specific properties. That's it. It doesn't have to be under contract, but practically you want to be negotiating with that seller. Jennifer, if they have to constantly buy a new property at or above their price, how do they actually achieve a tangible income? Jennifer, I'm going to give you the secret. You ready? Equity harvesting. You do an exchange, you roll all the money in. After the exchange is over, you do a refinance, you pull your equity out after the exchange through an equity harvest or a refinance. I've done that personally. That's how you get access to your exchange equity. George Gomez, can the proceeds of the sale be invested into a business, not stock? No, George, you can't. Like-kind property has to be real estate held for investment for other real estate. You can't go into a business, you can't go into stock, you can't go into inventory. It has to be into another property, either held for investment or another property used in your business. Let me go on to get back to the slideshow here. Questions are great. Identification is very specific. It must be made in writing. It's got to be very specific in writing. You must unambiguously describe the property. So it's got to be a street address or a legal description. If you're identifying a condo, it's not a 2-bedroom, 2-bath condo, but it's unit 37 or unit 82, specific units. That has to be done by midnight of the 45th day. Generally, that'll go to the qualified intermediary. So let me kind of come full circle, and I want to just touch upon the highlights of a delayed exchange. First, you want your client to consult with their tax advisor and a good qualified intermediary, just to get an overview. Second, you want to make sure that it is an assignable contract. That's important. We will share an exchange cooperation clause with you that you can use. You might have something that your firm uses. All the documents, number 4, need to be in place and signed before closing. There's no way around this. Then the taxpayer has 45 calendar days to identify property under those identification rules. And then they have to close on property identified within another 135 days after that, or their tax filing date. No wiggle room. You can't substitute properties after day 45. You can only buy what's been identified in that 45-day period. Now, when you're working with Stewart, and let's say a client decides to set up an exchange at the very last minute, we can do that. You want to stop the closing, right? You want to make sure that the property doesn't close. Then next, you want to contact a qualified intermediary. We do a lot of these a month in. We can have documents in place within a matter of a few hours. So call us, work with Stewart to call us. We will get a copy of the contract and title commitment, and we will get the documents in place, converting it from a taxable sale into a 1031 exchange. And some of the things that we're going to prepare, we prepare an exchange agreement, notice of assignment, we set up an account, and then we give very detailed instructions to the closing officer on how to set it up as a 1031 exchange. Now, there's a prior question here about multiple properties. So let me look at 2 different scenarios. This is one of a taxpayer selling 3 properties, consolidating the equity into one larger property. So these properties here, they get them sold. The money goes to qualified intermediary. The qualified intermediary purchases the replacement property and has it deeded back. If you're selling multiple relinquished properties, whenever property number 1, the first one closes, that's going to start day 45 and 180 for the rest of the exchange. So if you're selling smaller properties and going to a bigger one, you want to get the first property under contract, but push back your closing date, and then make sure you list the others so they're going to close reasonably quickly. The more common scenario is this one. I sell one property to a buyer. The money comes to asset preservation, and then we're going to split it up and buy 3 replacement properties and have those deeded back to the taxpayer. So this is by far the most common scenario: sell one and go into multiple properties. There are other ways to do exchanges. You can do what's called a reverse exchange. Buy the new property before you sell the existing. So these are much more complicated, a lot of moving parts, but reverse is I want to buy the new property and then I have 180 days to sell the existing. An improvement is I want to build something new or refurbish it, or a reverse improvement is I want to buy a new lot, start building on it, and then sell the existing. So I'm not going to go into the mechanics. These are options that are available to your clients. They're considerably more expensive and complicated, so they can be done, but just know that there's a lot more going on. I'm going to go ahead and answer some more questions from Lisa. Once you identify properties, can you select a different one outside of those 3? Lisa, no. So within the 45-day period, I can identify one and I can substitute. I can do whatever I want. Whatever you've identified by midnight of the 45th day, you either buy those properties or you don't. If you don't, it's fully taxable. So there's no way to identify after midnight of the 45th day. But I could on day 3 identify A, B, and C. I could revoke A, B, and C, and I could substitute with D, E, and F. So anywhere within the 45 days, I can do that. If I close on it, it's considered identified. but you can only purchase and exchange what's been identified. And I know people, this looks complicated and it's a hassle. These are the tax rules. It's been this way for a long, long time. It's a great strategy for your clients, but they've got to follow the time requirements. So that's the answer on that. Let me go a few other questions here. Once I got answered that one. Let me go down. Equity harvesting. You like that term. Okay. How does the intermediary get paid if the exchange falls through before closing and the money goes back to the seller? All right, Dawn, we only make money once you close on a property. So if the sale doesn't go together, we don't, at asset preservation, we don't even charge a cancellation fee. So we charge on our end, I'll tell you our fee, $1,250 covers one sale and up to 3 purchases. So it's a really modest fee. We don't nickel and dime people, they can buy up to 3, which covers most scenarios. If the property doesn't close, we don't charge a cancellation fee. I believe other companies may, but that's just our policy. If we don't do the work, then we're not going to charge a cancellation fee for that. All right. Has the intermediary get paid? Let me just scrolling down here. If a property closes April 1st, does the exchange lose the 100? No. So Claire, it does not. If you sell on April 1st, it would in 2023, that would be then reported on April 15th, 2024. So you still have the 45 days to identify and another 135 days to close the property. Typical fees, Kirk, ours are $1,250. I'd say it's fairly typical, somewhere between $1,100 to $1,500. A lot of our competitors seem to charge more for subsequent purchases. We just have a flat fee that covers one sale and 3. Some companies will say, hey, it's $1,000 plus $250 for each purchase. Everybody's a little different. There's no universal fee there. All right. Buyer purchased an out-of-state property just before COVID, did some updates, new roof, furnished, planted around it, then it occurred. They've owned it for 3 years. Can they do a 1031? No income. So this is a great question for a CPA. I think you want to have some rental income. I understand what you're saying about the intent was to hold for investment. This is a question where you need a CPA. There are different viewpoints on this. I think having some rental income in a 3-year period would be very, very wise, even if it's just a few months. But that's more of a question for a CPA because they have to look at all the facts and circumstances. Does API work with properties outside of Florida? Yes, Eric, we're a national company. So just a little background, all of our transactions for the East Coast, including Florida, we run those through our New York office. We've got a headquarters in California. I'm in Colorado, but we work in all 50 states. All right, I'm going to go back onto the presentation here. I want to talk about a planning opportunity, which is 1031, which is tax deferral, and 121, which deals with a primary residence. When you have a primary residence, if you live in it 2 out of 5 years, you can exclude gain. And what we look at here is you've got really 3 different scenarios. We could do what's called a split treatment, some 1031, some you live in. We can convert a rental into a residence, or we can convert a residence into a rental. So I think most of you know 121. You live in it 2 out of 5 years. Single filer gets to exclude $250,000, married filing jointly $500,000. A split treatment is when I've got some used as a residence and some rented out. And there are a lot of different ways to do a split treatment. You could have an Airbnb of a few rooms. That could be a split treatment. You could have a large farm or ranch where you farm on it and you have a modest farm home. So you're going to need a CPA to come up with the allocation. But here's a simplistic example. You've got a 4-plex. You live in one unit for 2 years. You rent out the other 3. So you're going to sell this to one buyer. The money on the primary residence, you put that money into your pocket tax-free. The other 3 units then were exchanged, and then you're going to go ahead and exchange for other like-kind property. This was an earlier question. I knew we'd be getting to it. What about converting a rental you exchange into your residence? So many people in Florida are buying investment properties in Florida that they intend to do what? Eventually move in and retire. So maybe it's an investment now, and in 5 years, they want to move into it and make it their retirement home. They want to get out of snowy cold Colorado or Minnesota or Michigan or Maine. So you can convert a rental into a residence, right? You can do it. You only get, when you later sell it, the 121 exclusion on the amount of time that it was lived in over the total ownership. So first, your intent must be, I want to rent the property, right? So you rent it out. So let me walk you through an example. Taxpayer does a 1031 exchange into a property in Florida. They rent it for 3 years. They now decide they want to move to Florida and live in it. They live there for 5 years and they sell it. There's an 8-year holding period, 3 of them rental, 5 they live in. Well, they get 5/8 of that 121 exclusion under the primary residence rules. So your intent must be initially to hold it for investment purposes. Clearly, that's got to be the original intent. The flip side of this is, what about converting a residence into a rental property? Let's say you're in, and I'll just pick on a place I know. Let's say you're in Jupiter, Florida, not the low rent district. You got a home worth $8 million. You move out of it, you make it a rental for a year or so. Because you lived in it 2 out of the past 5 years, you get to exclude $500,000 if you're married. And then you do an exchange into other like-kind properties. So you can convert a rental into a residence, but you can also go the other way. You could take a property that you live in, a residence, and convert it into a rental property. So there are a lot of planning opportunities on this. I'm going to go ahead. Look at this. Sam, I currently listed an investment property with pitch idea. Please share my contact. Pricing sounds reasonable. Hey, Sam, thanks for the kind words. I will have in a moment all of my contact. In fact, I have the company contact information, but I'll put mine up, as well as some of the people with Stewart. I'm trying to give you in a relatively short presentation a lot of information. Stewart's perspective is, if we equip you with tools that help you put a deal together that you couldn't have before, your client wins, you win because you're making a commission. A lot of times you'll work with them on the purchase and make 2 commissions. And we hope you bring that transaction over to Stewart Title. If you've worked with us, great. If you haven't worked with Stewart before, give us a shot. We do a really, really good job, and we'd love to work with you on that upcoming transaction. All right. If you buy an investment property, 2023, and live there till primary till 2/25, you sell it 10 days prior to the 2-year anniversary, can you pay capital? Okay. You buy a primary in 2020, you live there to 2/25, you sell it 10 years prior. Oh, so super easy. It's 2 years out of 5. You either live there 24 months out of 60 or you don't. If you live there 23 months and 20 days, it's not 24, you have to pay all your taxes. So you guys, tax law is there to help you. And hopefully you're seeing that there are all these planning opportunities, but you got to follow the time periods. There's nothing I can do. The time periods are statutory. They're set in stone. So 2 years equals 24 months out of a 60-month time frame. You're going to have to hit that one on there. So that's the key there. All right. Let me look at the other questions coming in. How about they rent for 1.5 years and live for 6 months, total 2 years? Can this be a 1031? So this is a good question. I need to know more information on this, right? It's got to be rented to qualify for 1031. It has to be a rental property, meaning held for investment. If they have some personal use, it's now going to go back to that revenue procedure, that 2008-16. So under that one, 2 weeks of rental income. Well, it's been 6 months. But the problem is they live there for 6 months. 6 months is over 10% of the time it's rented. It doesn't qualify. So again, you've got to follow the rules. You got to keep your personal use under 2 weeks or 10% of the time that it's rented. So that's the key thing. When you do an exchange, your clients are going to have to fill out this tax form. It's called 8824. They're going to have to say when they identified the property. So every time you do an exchange, this particular tax form gets filled out and sent to the IRS. And finally, kind of coming down home stretch, when you choose an intermediary, we're not in a federally regulated industry. There's no federal oversight. The most important question is the security of the funds. There have been some huge defalcations. I won't get into those in bankruptcies, hundreds of millions of dollars. Security of the funds is the most important thing. So I want to give you some criteria to look at. Does that qualified intermediary have the written backing of a large credit-worthy entity? Really important. And I'll tell you, we're part of Stewart. Stewart provides free of charge a letter of assurance assuring the money will be there and asset preservation will facilitate the exchange. What's the financial rating and balance sheet? Well, Stewart's been in business for 127 plus years. Very conservative with finances, very solid financial position, listed on the New York Stock Exchange. And then where do we put the money? What sort of due diligence? We can only put money in certain top tier banks. Now, the next slide is the most important question to ask. Does the qualified intermediary offer a segregated account? You want the money put in a separate account for your client. You don't want it commingled. They can set up a qualified escrow or trust account. You can look at the fidelity bond insurance, but having a separate account is absolutely key. That's the way that we set that up. And I'm gonna look at a few questions coming in here. Can you rent as a person or you have to be incorporated? Oh, anybody can rent. You can rent as an individual. I happen to set up LLCs, but an individual can rent a property. A lot set up LLCs for liability protection. From Cindy, how is the money treated when you improve a property? I purchased for $195. I put $150. Is the money subject to exchange or can I get cash back? Those are just improvements. So you can do an improvement exchange, Cindy, for the extra $150. If you put that money into it, that just increases your basis. So on that particular property there, you're going to have what 245, 345, I think, into it. So you can do an improvement exchange if you want, but whatever you put into it is what you put into it. You can't get that money back out. Any money you pull out in an exchange ever is always taxable to you. That's the key thing to keep in mind. We offer here, being part of Stewart Title, we call it the API Advantage, experience, expertise, security. The number one thing we offer is security. We have a letter of assurance that comes from Stewart Title standing behind all of the money, and that's really a key aspect there that we provide to everybody. It's a big differentiator. And, happy to help you out on that. In terms of reaching out, if you look at the screen, the best number to call in your area is 866-394-1031. My email, I don't have it on the screen, is scott@apiexchange.com. So scott@apiexchange.com. Email me anything. I'm happy to help you out, send over additional information. We've got a website, apiexchange.com, that has a ton of information on